Well, thank you, Matt. I'd like to introduce myself. I'm Joseph Kenny. I'm the managing partner at Paisley Elm. Our firm specializes in Medicare cost reports and cap reports and related accounting issues. I'm a CPA, CMA, and CCRS. The CCRS is a certified cost report specialist. So every year we have continuing education to make sure that we're compliant with completing the rules and regulations on completing the cost reports for the providers. And over here, you can kind of see some of the cost reports that we do: skilled nursing facilities, home office cost reports, which we're going to go over a little bit later in the example, critical access hospitals, federally qualified health centers, home healthcare agencies, and of course, hospice agencies. That's what this webinar is tailored about. Some community mental health centers and end-stage renal dialysis centers. So we also focus on Medicare compliance, bad debt analysis, but that does not apply to hospice. That applies to SNFs, critical access hospitals, and some renals. We also do analytical reviews of cost report data, and we do complete hospice cap reports, which are coming up shortly. So this is a little more background on myself and the firm. I've been doing this now 30 years. It says 29, but in 2024, I'm starting my 30th year and doing cost reports and related issues. I've also worked with the following MACs, which are Medicare Administrative Contractors, NGS, which is National Government Services, Noridian, Novitas, Palmetto GBA, Cigna, which is CGS, and First Coast out of Florida. Some of these intermediaries you're not going to be familiar with because there's only 3 that administer the hospice program. So the webinar today is broken down into 4 components. The first component is mainly just an operational background overview. The second stage is the hospice cap reports. That's a relevant issue because they're due February 28th. And everybody's on the same cap here. The third section is hospice Medicare cost report. We only use select sections of the cost report for this webinar because we have limited time. And then there's some derivative management reports that you can complete using the data from your financial statements and also utilizing the information off the Medicare cost report. So just again, the overview, you got the appropriation, the CMS, Centers for Medicare and Medicaid Services, they're in charge of the Medicare program. What they in turn do is they subcontract to 3 MACs, or Medicare Administrative Contractors. They used to be called intermediaries. They subcontract to CGS, NGS, and Palmetto GBA. So then after that, you as a provider have to interface with either one of the 3 for all your payments, your enrollments, compliance, cost reporting, cap, etc. And then, of course, the patient receives the care from the provider. So we took a sheet from the Congressional Budget Office, and it kind of shows the global amounts that Medicare is having to outlay in current years and projected. This is just a little bit of information on Part A, Part B, and Part D. But the next slide is the relevant slide. And it's the very top line. We've got it highlighted in yellow. I'll put my cursor over here. The actual 2022 total Medicare outlays is $975 billion. You can see in 2023, it's $1 trillion. Then the Congressional Budget Office forecasts based on participants and estimated cost flows globally for Medicare. 2033, you're at $2.1 trillion in outlays. So you can see it's growing. It's basically doubling in 10 years. And due to the age of the population, increase of cost for services. The other spreadsheets in here are just more information on participants and other information. And then these are the footnotes associated with the sheet that we got from the Congressional Budget Office. So at your leisure, you can go back and take a peek at those. And this slide here shows globally hospice Medicare certified agencies only what the expenditures were in the Medicare program for 2019. They were $20.9 billion. You can see in 2020 is 22.4, and then finally in 2022, it's 23.9 billion. So you see a progression, an upward slope of the line that you see the costs are increasing for the agencies. And this is just a little bit more information on CMS, provides the health coverage for 100 million people through Medicare, Medicaid, and other programs. Contracts with the MACs, which we kind of went over. And here's the roles. The basic role of the MACs is going to be to process the claims and our favorite audit institutional provider cost reports. There's assorted other issues here, but kind of gives you the background. And this is a nice geographic picture of all the intermediaries slash MACs in the United States. So if the provider is in California, NGS is your MAC. If you're in the state of Texas, it's Palmetto GBA. And if you are in Illinois, it's still Palmetto GBA. And then you can see CGS has the turquoise colored state. So it's just between these three, and this is only for home health and hospice. Other types of Medicare providers have different MACs. Now, as far as the cost report, again, this is the overview of, the Medicare piece. The cost reports are dictated from Medicare under the Provider Reimbursement Manual, Section 15, Part 1 and Part 2. Part 1 is going to be just general guidelines on how Medicare works, what are allowable costs, what are non-allowable costs, what are direct care and indirect care, what's the apportionment of overhead costs. So it's just a general overview of the regulation. Part 2 is going to be detail. It's going to have specific forms and instructions for each type of cost report that's due. So there's a section under Part 2, Section 15, just for hospice agencies, detailing out every form that's associated with the Medicare cost report, which we'll go over in a little bit later. It also then dictates, which you'll see on the cost report worksheet B-1, which is a statistical approved allocation methodology to apply overhead to direct care and non-direct care, or unallowable costs. This slide is nice because it shows the actual number of certified agencies. And you can see in 2017, there were only 4,146. New agencies that year were 294. Old agencies or existing agencies, 3,852. Fast forward to 2022, and you see now we have 6,068. The new agencies have dropped off, but look at 2021. 684 new agencies were added in that fiscal year. So competition is growing. The market is starting to get saturated. This is just a graphical representation of the prior slide. It shows the 6,068 far right-hand corner, total agencies, old agencies, new agencies. And then you can see in 2021, the dispersion there, the 684, all the way back. So you do see a gradual upward sloping of increased number of agencies. Now, for the summary for the operational environment, you can see that Congress appropriates the money. Money is appropriated by Congress, goes to the Medicare program. You can see that it has grown 2022, 975 billion, projected 10 years out, 2033, 2.1 trillion. The administrative structure is CMS is in charge of the program, and it in turn subcontracts out to the MACs, which we went over. The regulatory framework, again, this is for the cost reports, cap reports, etc., is in the Provider Reimbursement Manuals, 15 Parts 1 and 2. And just a general recap of the hospice agencies. 2017 to 2022, you have a 46% increase in agencies. Payments to hospice agencies will decrease over time because this industry is where home health care was 25 years ago. So you can kind of look back and see what happened to home health care agencies over the growth course of time. And what it basically boils down to is Congress is under pressure to restrict the amount of payments to the agencies, and then you get an increased number of competition. So the result is agencies are going to have to deal with reduced reimbursement in future periods and an increase in competition. So the next section is the hospice cap reports. So we do an overview, what the cap limits are, the due dates, the forms, and then unfortunately, when there is a liability due, if the agency cannot pay for it immediately, they can request an extended repayment schedule. And there are forms, instructions, and interest rates associated with that. And then this is not really discussed much, but it's called the look back period. Medicare is required to look back 3 years, and we'll go over that in detail on the cap reports to see if there's any new or additional liabilities. Okay, so the hospice cap, the aggregate cap calculation pertains to overall Medicare payments that the agency has received. The calculation is relatively simple once you have the data. It's the number of beneficiaries in the cap period times the cap limit, and then you compare that to the amount that you received on the PSNR system. All the data has to come from the PSNR system. No software is going to be able to produce this. I know some softwares mock some cap reports, but you need to do this through the PSNR system. It's going to have all the data and the accurate data. Okay, so beneficiary count, determining the number of beneficiaries. Most people use the proportional method. Streamlined method is only for old agencies. The calculation obviously is for each hospice individually. And again, it's the Medicare beneficiaries. And what happens here under the proportional method, or whatever method is going to be used, the patient days, if a patient continues to receive services in multiple periods, that patient then is prorated as a beneficiary count less than 1 to the multiple periods. And that's what drives up the hospice look back period in liabilities. The time period is October 1st through September 30th. This is the hospice cap limit. So remember, we take the beneficiary count times the hospice cap limit, and you can see each year it graduates up. It's 32,486.92 for 2023. And you can see all the way back in 2019, it was 29,205. So again, increasing up. The due date, again, is February 28th, 2024 for the cap period for 2023. It's October 1st through September 30th. And the beneficiary identification period is the same as the payment. And you cannot produce these reports before January 1st, 2024. Otherwise, it's invalid. And each MAC has a little different calculation or supporting documentation. The cap calculation we're going to show you is for Palmetto GBA. NGS requires you to submit the supporting documents. Palmetto GBA does not. So each intermediary has their own protocol. So we'll go to a sample cap report now. It's a one-page document. So, and again, all the information is coming from PSNR and the miscellaneous report for the beneficiary count. So it's the hospice agency, the PTAN number, the NPI number is required for this. The cap year ending is 9/30/2023. You can see in this example, there are 54 patients. We ran the report under this example on January 1st, 2024. It's fully prorated. There's the cap amount. These are the allowable amounts that we can receive. It's $1,754,293. Unfortunately, in this example, the agency received $1.8 million. They owe back $45,906. So kind of a straightforward calculation that's got to be signed and dated, etc. Let's go back to the name. So this example, they owe back $45,000, which is not a material amount for most agencies. That would just be either paid off shortly, but let's pretend the liability is larger. It becomes material. The agency can't afford to pay it all back at once. And if you do nothing, the MAC will just offset 100% of your claims until the liability is settled. But you are given 15 days to request an extended repayment. Under this, here are the regulations. So if it's 11 months, 6 to 11 months, you just have to do 1 through 3. Pretty easy. Amortization schedule, copy of the repayment letter, and the first installment. If you go over 11 months, you are required to do 1 through 14. Key component here is the cash flow statement and the projected cash flow statement, because the MAC is going to be able to determine from your cash flow statement, which is just the reconciliation of net income to the net change in cash. It's going to determine whether or not the agency has the ability from current operations to pay back the amounts owed to Medicare. If the cash flow statement is poor, they can deny the request. And the projected cash flow statements are in the future and relatively complex to complete, because there's a lot of data that you have to put into them. And look at number 14. That's a key component here. Interest rates, and they change. They are published. HHS, as of 12/31/2023, any overpayment back to Medicare is 12.125%. So the interest rates are very, very, very steep. We're going to go over now the look back period. And again, this is glossed over usually. Most people don't talk about it, but the liability, remember, the patient can prorate if they're receiving benefits in multiple periods in prior periods, because it's eating up in future periods. So what it does, if your liability, let's say, is $1,000 in 1 year, and then they look back at it and that patient eroded, your liability can be $2,000. Again, you have to look at all the variables here. But this example here, I took, it was Palmetto GBA's response to OIG. The OIG asked Palmetto GBA if they were collecting all the overpayments, and this is the response on what they said to the OIG. So this, you can just drop in, new dates, but this is taken verbatim from that. So the look back is 3 years. So you can see the initial cap year, 2014. So in 2015, the MAC's going to run it on their own. They're not going to require you to do self-determination on this. They're going to run it on their own and determine in 2015, do you owe money back in 2014? And they do the same for 16 and 17. So 17 will be the final look back period for 2014. And like I've said, if the patient is receiving future benefits, and they can be at another agency receiving those benefits if they were discharged, that patient's still going to erode your prior beneficiary account, because it's now receiving, or they are now receiving, benefits by another hospice agency. So kind of crucial. What we recommend is people run these reports quarterly. That way they can determine whether or not they are under or over, instead of getting a huge surprise at the end of the year and then you owe this money back and you have to scramble. Now we're going to go into the hospice cost report. So on the hospice cost report, we are going to look at the purpose of the report. We're going to overview select schedules. Again, it's too complex and there's not enough time to go over everything. Then we'll do the sample worksheets, and then we'll do the due date. So basically the purpose of the cost report, think of it globally. Medicare wants to know what it costs in your geographic region to provide and deliver that type of care. So the final thing is you're boiling it down to cost per day. And there is the protocol on how they get there. The financial statements should be prepared according to general accepted accounting principles, overhead allocation, and to the type of hospice care, to the level of care. It comes up with a cost center that's fully allocated, and then it takes the number of hospice days associated with each level of care, and also in total to come up with that cost per day. Then they use this to set future rates for agencies based in those geographic CBSA areas. So that's the essence of the cost report there. This is a nice slide because it goes over of the cost report, the 1984-14, that's the name of it, CMS document. The worksheets are divided between S, A, B, C, and F. Now, for complex cost reports that have subcomponents, there'll be a few more schedules, but this should cover almost everyone at the seminar here. So worksheet S is the certification page. S-1, you have hospice days in your geographic location, CBSA. S-2, you have to say who is preparing your cost report. And there's some other pertinent information, disclosure of related parties. Worksheet A series is all expenses. So worksheet A singular is all the expenses associated with your agency in totality, direct, indirect, administrative, non-reimbursable, etc. A-1 through A-4 are all related to direct care expenses only for the level of care. So you can see continuous care is A-1, A-2 is routine care, A-3 inpatient, and A-4 GIP. A6 takes and reclassifies expenses because sometimes on the trial balance of the financial statements, adjustments need to be made, or reclassifications, I'm sorry, need to be made from line item to line item. Because remember, it's all set up for cost centers and allocation. A-8 are the adjustments to the expenses, because remember, Medicare does not want to pay for certain expenses. And there's a bunch of rules and regulations on what is an allowable expense and non-allowable expense. And that's in the Provider Reimbursement Manual 15 Part 1. A-8-1 discloses related party disclosures. This is if you have control, home office, etc. Worksheet B is the actual allocation of administrative expenses down to level of care and non-reimbursable expenses. And as mentioned before, worksheet B-1 is the approved statistical basis for allocation. So for instance, employee benefits are allocated and the approved methodology from Medicare is based on gross wages by department. Worksheet C is where it summarizes the grand totals from worksheet B for level of care divided by the hospice days to come up with the cost per day. Most important part of the cost report is worksheet C, which we're going to go over an example real quick. And then worksheet F is just the financial statement disclosures, which is the balance sheet, the income statement, and changes in fund balance. And everybody might be saying, well, what, we don't have a fund balance, we're not a non-for-profit. It's fund balance is also the equity section of a for-profit entity. And now we'll go to some of the sample forms on the cost report. So here we have the very first page of the cost report, and I'm going to put my cursor up here so everybody can see. Worksheet S is the identification. You can see the report is the 1984-14. This is worksheet S part 1 and part 2. So here's part 1, here's part 2. Part 1, and before you get to part 1, here's the fiscal year, here's the agency name, and here's the PTAN. No MPI numbers required for cost reports. Type of cost report it shows is full under part 1, and down here is the certification page. This is where it's certified by the CFO or the administrator right here. And what this is stating is that management has reviewed this report. It's in full compliance with Medicare rules and regulations under part 1, part 2, and they have they're attesting to the fact that that's true and correct. So very important page here. This is worksheet S-1, and this is where the agency name would be, and here's the address. This is just an example. Fiscal periods here, dates of certification for Medicare, Medicaid. This example, we threw in home office, so make it a little bit more dynamic, so you can see the related party disclosures. Now down here, under part 2, this is relevant because it's the hospice days. And again, it breaks it out by Medicare, Medicaid, and other to get the grand total. And here's the level of care. This is what you're going to see on worksheet C. You're going to see the level of care total expenses, and then you're going to see the expenses divided by the actual number of days in total and by level of care. This, if you recall, we did worksheets A1 through A4 are direct care expenses only by level of care. A2 was chosen because that's where the majority of expenses are. And you can see the way it's set up is salaries, other, which is usually contract or DME or patient transportation, non-routine medical supplies, labs, and diagnosis. And these are all the wages here. These wages are gross wages. They are not, there are no fringe benefits in that. That's an allocation method on A. Then you come to a subtotal for level of care here. In this example, there's no reclassifications and there's no adjustments. That is due to the fact that this agency probably has a crosswalk that already carves up the statements. So there are no need for adjustments or reclassifications. But on worksheet A, there always is. And we're going to go to that next. And here's worksheet A. Again, here's the fiscal period, agency. Lines 1 through 17, these are all administrative. Lines 25 through 46, direct patient care. Lines 60 through 71, non-reimbursable expenses. So remember, the goal of the cost report is to take allowable administrative expenses and allocate them down to the level of care. And you're going to see on worksheet B, this changes here to level of care, and it's rolled up by A1 through A4. You can see in this right here, we have the total expenses of $25 million. This should tie back to the income statement. Medicare, when they receive the cost report, they cross-reference to make sure the total expenses match what's on the financial statements. And the most important document is the trial balance. So that figure then has to tie back to that number. That is the total expenses. Now we do have one small adjustment here, or I'm sorry, reclassification, because they moved from plant and operations back up to A&G. But you see here we have plus and minus on adjustments. So every cost report should have some sort of adjustment because no agency has 100% allowable cost. Medicare always has a disallowed area, and we'll go over that in a minute. Here is just worksheet A-6, which just shows the reclassification to A&G from plant and operation. Here is worksheet A-8, and here you see adjustments resulting from transactions with related organization or home office. And it's a plus, but you can see down here we have minuses, a net negative, and that ties back to worksheet A. So the revenue from the room and board is negated out because it is a pass-through expense. It has nothing to do with administrative costs being associated with the function. Meals and entertainment are taken out because those are non-reimbursable centers or non-reimbursable expenses. You can see the line items here: 70 for room and board, 4 is A&G, and then advertising A&G minus, because Medicare doesn't want to have in the cost pool expenses associated with advertising for patient care. That is it doesn't have anything to do with patient care or the administration of, so it's just clean cost. So if we go to the next slide, A-8-1, this discloses the home office. And you can see the amount allowable in the cost report is in this column. Whoops. And the amount that is not, or the amount that is included in the cost report is here. You have zeros here. We don't have anything in there for employee benefits. But from the home office cost report, it states that, hey, there are employee benefits that need to be included to appropriately show the expenses of this provider to deliver this care of $2,733,000. So there's a plus, but there's a minus here. You can see that the amount allowable from the home office cost report is only 1.5 million, and there was almost 3 million, so it's a negative 1.4. And again, there were some miscellaneous expenses here that were not included. And again, the home office cost report, typically the home office is a separate entity, And it has administrative expenses that are shared, and there can be certified providers that it's allocated to and non-certified, or any combination thereof. And that's where those numbers are derived from. This is worksheet B. And again, look at the level of care. All those lines have now been condensed into just level of care. Here's the administration. So worksheet B allocates all the administrative expenses down to level of care and to the non-reimbursable centers to come up with the grand total in column 18, continuous level of care, grand total expense, routine, 23, 257, 105, et cetera, et cetera. These are non-reimbursable expenses. So worksheet C now takes the expenses associated with the level of care and it divides them by the number of days. Oops, right here. There we go. So you have on worksheet C, there's the continuous care, and there's the cost, there's the days, that's the cost per day. Routine home care, again, this is where the majority of all expenses and days are going to be. You have the total expenses of the 23,086,000. It's 267.64 per day. Again, with inpatient respite and GIP, and the grand total, which is probably the best number to look at for analysis, is the 270.66. Grand total of all care divided by grand total of all days equals the cost per day. So the cost report is due 5 months after the end of the fiscal period. So fiscal year, your fiscal year can be whatever you set it to be when you got the provider number. Excuse me. We have all types of fiscal years in our agency. We have fiscal year ending January 31st, February 28th, all the way through the year. Most agencies, though, have a calendar fiscal year. And your fiscal year with Medicare can be different than your tax fiscal year, too. So that's always good to know. Now, the final piece of our webinar here is to kind of look at some management reports that you can derive from your cost report and also your financials. So the first part is using the Medicare cost report data. We've got a regression analysis, which shows the cost per day. This is just to predict what this agency's costs are going to be in the future based on past performance. Another analysis is taking the cost per day and breaking it down by direct and indirect care to see, well, what are the components here? This drills down even further, direct care only. And this is an interesting one. It's cost per day compared to the group, meaning how do you compare to the peers on your cost per day on worksheet C? And then cost volume profit analysis is a fancy word for break even or profit planning. This is the regression analysis. And in this example, the cost per day is 207 in 2022. 2021 is 184, 174 in 2020, and in 2019, 156. So the trend line is fitted into this to give us a predictive pattern on where our costs would be in 2023 and 2024. And you can see this agency is getting very expensive, and it's going to have to figure out why are their costs going up, and then they can do more detailed analysis inside with other. You can see here, this is the cost per day here, but it's taking direct care only, indirect care, and then total cost per day. So then they can see if there's any patterns associated with increase in expenses, and it does it by fiscal year. So management can then look at this and determine, hey, where there is an area that needs attention. And this is a further drill down into the cost report data, and it looks at what is the cost per diem for nurse practitioner, RN, LPN, MSW, spiritual, and HHA by fiscal period. So then you can kind of see which bucket is moving up. Maybe management can make people more productive. Maybe they can use more LPNs versus RNs. And that's something management has to analyze. This is basically the histogram of all the agencies and what their average cost per day is on Schedule C. So again, this is trimmed up data, But let's say your agency, let's see, most agencies are falling into this range here of cost per diem. What if your agency was over here at, let's say, $256 today per diem? There's only 22 agencies in the whole group. So you'd have to wonder, well, why is my agency way skew of the peers in the cost structure? And then you can do that internal analysis that we talked about above. This is an example for break even days in revenue, but this has nothing to do with any of the prior data. This is just a simple math project. You would put administrative cost here per annum, put in your revenue per day, and then you'd have to have your variable cost per day. In this example, it's $66 per diem, and that gives what's called a contribution margin per diem, $99. To break even, you divide your fixed cost by the unit contribution margin, and that is the number of days, 253. So you can see graphically here. So expenses, total costs are equal to total revenue at that point. So there's no profit, it's a break even. Break even sales, you just take the number of days times the revenue per day to get your sales. Again, this is just for math, so you can play with it yourself, but you put that in. Now you could do, this could be per annum, or this could be per month, it could be per week. So you can change the analysis. Over here would be profit, over here would be loss. The other area that management can use the financial statements to do a ratio analysis to see how their agency is doing. So under the financial ratios, there's profitability, there's leverage, liquidity, efficiency. So banks, if you borrow money from a bank, there's going to be debt covenants and there's going to be ratios that you have to fulfill, otherwise you violate the covenant and they call the loan. So those are kind of key in the loan area. But profitability, management can set their own metrics and determine what their profitability should be, and set up their own analysis. So let's go here. Hospice management reports financial statements. Again, you want to make sure your financial statements are prepared correctly, utilizing general accepted accounting principles, and you can come up with these ratios. Liquidity ratios are just that. Is the agency able to fulfill its current obligations based on its current assets? So you have a quick ratio, you have the current asset ratio. So profitability, management might say, okay, based historically, we're making 15% net income percentage. We want to analyze that and try to get it to 18% or whatever they deem as reasonable. So you would historically have these net profit margins, and you can create the spreadsheet and you go from quarter to quarter, year to year, month to month to determine that. Return on assets really doesn't apply because hospice agencies are not typically bound with huge capital expenditures. Return on equity, again, depends on the type of entity structure you have. Because if you're an LLC or you're an S corporation, you're probably distributing to the owners most of the net income. So the equity that resides in the business, it's not really, relevant. And here we go with the leverage ratios. Debt to equity, total debt to total equity. Again, the banks are probably looking at this. Definitely, they're looking at interest coverage ratio, the earnings before interest and taxes, EBIT divided by interest expense, to see your ability as an agency to cover the interest. And each bank's going to have their own subjective amounts that they want in those ratios. Activity ratios, these are great. These are fun because you can look at accounts receivable turnover ratio, which is going to determine how quickly you're collecting your money after you bill it. So this should be a relatively clean one. Accounts payable turnover ratio is how long you take to pay your bills after they accrue. And then again, coverage ratio is the time interest earned ratio. and the debt coverage ratio are extremely important for banking. So, in summary, you've got the operational environment. You've got 2023, 1 trillion. You've got Medicare in 2033, looking at 2 trillion. Total hospice outlays in 19, 21 versus 24 in 2022. So it's growing. The competition, definitely something to keep your eye on. 46% increase in 5 years. Again, it's going to slow based on some of the new regulations they have out there. It's going to decrease the appetite for people to start up multiple agencies, but you're still going to deal with the payment structure. Congress will always be under pressure to reduce the future Medicare payments. So you have to figure out how to deliver the care, have great patient care, but also stay afloat financially. And in the future, agencies will have to be competitive to survive the reduction in future payment and increased competition. Best practices are use the data from the Medicare Cost Report. Do not look at it as just a compliance obligation that it just has to be filled out once a year. There's a wealth of data in there, and CMS is using it, and they're collecting more and more detailed information every year. I remember when the cost report for the hospice agency was 1 page, and now you see how big it is and how much data they're collecting. The next thing is to have accurate data from your financial statements and the cost reports. And we highly recommend that you use a qualified individual that pays attention to GAAP, general accepted accounting principles, so they can accurately report your financial statements. And sometimes people think QuickBooks can solve everything. It's not. It's a database. You need to have the knowledge and understanding of when to recognize revenue, when to accrue liabilities, and how that needs to be offset. Management needs to set up their own benchmarks and key metrics to monitor for deviations. So you can once a year, once a quarter, once a month, sit down and monitor where your agency is at and where you want it to be. I'd like to thank everybody very much. I know we went over a lot of information relatively quickly. If you have additional questions, you can always shoot me an email or you can call me. And what I'd like to throw out there, because we do have future seminars, if there's an area that you would like to see more information on, please inform myself or Matt so we can address that in the future seminars. So thank you so much for your time.
Thanks, Joe. If there's any questions, you can go ahead and submit those. I have one here, but either submit those into the Q&A while we have a few minutes left, or raise your hand and we can unmute you so that you're able to ask those verbally to Joe. I'll tee up the first question and we'll see if we get any additional. Joe, the first question is, what expenses do you commonly see underreported on cost reports, or when an agency comes to you, they're kind of teed up to underreport on?
Oh, easy. That one's a very easy one. Most agencies don't have, everybody can operate on a cash basis financial statement system, but under the rules and regulation, it has to be accrual. So they're wanting to match revenues and expenses to the time period of the cost report. What we see is most agencies don't have an accurate accounts payable. They'll understate what the true expenses are because they haven't accrued the liability in accounts payable. The revenues over time, cash and accrual equal, but it's the individual mapping of that expense to that particular time period. Because remember, if you understate that expense in one period, the patient days are going to be different in the post period. So you're misstating to Medicare what those costs are and most likely understating them.
Thanks, Joe. Is there any other questions from the audience before we wrap up? All right. If you do, like Joe mentioned, you can always send those through after today's session. And again, we will have a fourth and concluding session in this series on February 8th. And we'll be sharing out the recording of this webinar as well as the presentation that Joe took us through. Thank you all for spending either your lunch or your morning with us. And thank you, Joe, for a wealth of knowledge and a ton of very useful information.
Thank you. Much appreciated.
All right. Thanks all.